Hello, everybody. My name is Scott Sinclair, and welcome to The Grow. This podcast, The Grow, is about business fundamentals as applied to the business specifically of cannabis. It's about fighting through the negativity, the industry downturns, and exploring instead the hypothesis that you can make profit in this industry with this type of business, and there is capital available to you. This podcast is not about the commodity or the genetics. It's not about the hot new product. It's not about the efficacy of the commodity or the societal benefits. It's not about regulation, at least directly. Nope. This podcast is about leadership and management and business fundamentals and controlling, most importantly, controlling the things that you can control. It's about making more money, improving cash flow, restructuring fundamentals, raising capital, creating shareholder value, and realizing on that shareholder value. This will be our focus on the podcast, The Grow, of which this is episode 1, by the way. Episode 0 was last week. We're going to do a weekly 10-plus minute show, keep it short and sweet, and give you, hopefully, some real value for your cannabis business. This episode is brought to you by Sinclair Range. Link in the bio to go check out the website at www.sinclairrange.com. Sinclair Range helps all businesses, including cannabis businesses, raise capital, turn around operations, restructure debts, and generally execute on all of the strategies that we will be discussing on this podcast. So go check it out, sinclairrange.com. It's in the link, and call us. Call Sinclair Range for free. You can do it on a note to this podcast. You can email, go to the website, to the contact form, and you can talk to somebody, maybe even me, for free to discuss your specific situation and see if we can get you headed in the right direction. So today we're going to talk about Cresco Labs. Cresco Labs, C-R-E-S-C-O Labs Inc. Trades on the CSE symbol CL, on the OTCQX symbol CRLBF, on the FEC symbol 6CQ. So the CSE is the Canadian Securities Exchange, and that is a small but actually regulated securities trading exchange where you can buy and sell stocks, normally focus on entrepreneurial and high growth companies, bit of a feeder junior exchange. The OTCQX is the US-based over-the-counter market. Used to be what us old people would call pink sheets. But the over-the-counter market, where you're more trading directly, individual to individual, but of course you're not. You're doing it through a market maker. And the FEC is the Frankfurt, Germany exchange, which is a legit regulated exchange. Sorry, I put a timer on for this show, and then it just keeps popping up notifications to me, so I got to turn that over. We're going to figure out how to time this, because if you listen to episode 0, I sort of blew that. It didn't have a timer available to me. Anyways, the Frankfurt Exchange, why would someone list in Germany? It's a legit exchange, and it gives you access to European capital. And back in the old days, stock promoters loved the German exchange because you could sell stock in there, and the German business community, investor community, just never sold, ever. And so if you're trying to get stocks to move forward, that's good. Anyways, that's quite common. Canadian Stock Exchange, over-the-counter in the U.S., and the Frankfurt exchanges are where these people trade. Now, you're going to hear this when it's released, and last week, Cresco Labs has released their financial earnings, and for me, it's like a day old, but for you, it's going to be about a week old by the time you hear this. But their press release says Cresco Labs is the industry leader in branded cannabis products with a portfolio of America's most popular brands and the operator of Sunnyside dispensaries. So they released their financial and operating results for the fourth quarter, ended December 31, 2024, and for the year ended December 31, 2024. Everything is presented in US dollars, of course, and in accordance with US GAAP, generally accepted accounting principles, which is a little bit different than IFRS, which is the everywhere outside the US, and those accepted principles, but that does not matter for this episode. Fiscal year 2024 highlights: revenue, $724 million. This is US dollars. So in CAD, they're over $1 billion of revenue. So a legit Big company, 724 million US for the year ended 2024. Operating cash flow of positive. Yes, I'm going to say positive. Do you remember this episode? Oh, sorry, this entire podcast is about exploring the good things in this industry and that we can raise capital and make money, and we can take lessons from those that are doing the job already. Positive operating cash flow of 132 million and free cash flow of 114 million. Gross profit of 364 million. Adjusted gross profit of 374 million. Gross margins of 52% of revenue, which this release makes me laugh, says is 270 basis points improvement year over year. That means 2.7%. I don't know why we're being so fancy with our 270 beep talk. SG&A, this would be your fixed costs predominantly, 221 million. Adjusted SG&A is down 12% year over year. So they're cutting their fixed overhead costs down to 29% of revenue. They did have a net loss for the year of 60 million, but that included a 66 million one-time charge for non-cash related stuff that I didn't bother to go look up. The fact of the matter is, when you exclude the extraordinary things, they actually have a legit net profit, and their adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, were a positive $200 million, up 15% year over year, and their adjusted EBITDA margin is 28%, nearly 5.1%. Here it says here 510 basis points improvement year over year. Let's talk about this briefly for the adjusted EBITDA. Now, my audience is for business owners, management, investors in the cannabis sector. Therefore, I'm going to assume that you're a little bit sophisticated on financial matters. I do other podcasts if you listen to me, and I assume that some of them are targeted towards people that are not sophisticated in financial language and etc. So we're going to try and find that happy balance here over the next few episodes, and as we go to how much we should disclose, how much we should explain and not explain. But the bottom line is adjusted EBITDA, earnings before interest, taxes, depreciation, and amortization, is something that's used very well. It's almost always used in valuing a business. And it is a non-GAAP measure. What is GAAP? Generally accepted accounting principles. What is a non-GAAP measure? Non-GAAP measure means this is just a made-up thing, a made-up metric that doesn't exist in accounting, but it's something that investors and management and stockholders, they all rely on this EBITDA information. And so companies report it, but their definition of EBITDA sort of changes because it's not defined by GAAP. That makes sense? And so the adjusted EBITDA is, you take your earnings, you add back your interest, taxes, depreciation, and then you look at it and you say, well, we should add back some other stuff too. And the other stuff we should add back in your industry, in the cannabis industry, would be fair market value changes to your biomass, to your inventory level, because you can just have wild swings in your cost of sales section of your income statement because of devaluation of the biomass or what have you. And that's not really fair. I mean, you have the same stuff you had last time. It's just a fair market value accounting, a fair value accounting thing to do, but it really doesn't fairly represent your operations. So people say, well, I'm going to add back the ups and downs from these changes in the value of my inventory holdings. Also, stock-based compensation, so non-cash compensation. Well, this is just another weird thing from accounting. So it adds back that, and that's all fair game. But when you are relying on EBITDA to value a business or to get a handle on a business, and when you are running a business and you're reporting stuff, make sure you have a consistent definition. Don't go too wild on this normalization. Stay within industry standards, and people will buy in to the normalization entries, as we would call them, but this adjusted EBITDA. Anyways, $200 million they're reporting in adjusted EBITDA, and 15% growth. 15% growth is huge. It is a huge number. Did you know the biggest driver, mathematical driver of the difference between a low multiple and a large multiple on EBITDA when you're valuing a business is growth? Growth has a huge impact on the multiple. The difference between a 4 times EBITDA multiple valuation and a 12 times EBITDA multiple valuation is growth. Almost always, just growth. That's it. So you have a 15% growth. That is massive. I'm not saying it's sustainable, which is another story. But we're going to cover multiples, I'm sure, in future episodes, but not for right now because we're not going to have time. So that was their earnings, knocked it out of the park. Fourth quarter, that was for the year. Their fourth quarter was revenue of 176 million, 20 million in free cash, gross profits of 84 million, SG&A of 56 million, net income of 400,000, adjusted EBITDA of 42 million just for the quarter alone, $42 million in adjusted EBITDA. Management commentary. In 2024, the team executed with, listen to this is the important part, discipline, streamlining operations, prioritizing profitability. And that's one of the themes of this episode is prioritize profitability, go back to first principles, make money, and you will be successful. With 132 million in operating cash flow, a leading brand position in our core markets, and retail productivity that outperforms the industry, our foundation is stronger than ever. In 2025, we're extending our focus to strategically deploy capital to create growth and maximize returns for the years ahead. It's a straightforward approach. Execute at the highest level, generate cash, reinvest in high ROI, return on investment opportunities, and repeat. Exactly. Kentucky is our first of these new market expansions, a strategic addition backed by clear regulations. As one of the only two Tier 3 cultivators in the state, we have up to 25,000 square feet of canopy, representing more than 20% of the state's total allocation. This allows us to scale efficiently, serve patients quickly, would be on the medical side, although it doesn't say that, and reinvest in our operations just as we have in Illinois, Pennsylvania, and Ohio. And then the CEO says, hey, congratulations to the Cresco team on a phenomenal 2024. Let's go in 2025. Agreed. Congratulations. Seriously, to the CEO, whose name I didn't write down, and to the rest of the management team at Cresco, that is how you do it. That's fantastic. Prioritize profit. That is applicable to any size of business, including yours. How? How do you do that? Well, we'll talk about in future episodes. Number one, contribution margin, not gross margin, as reported here in this press release. You have to do that because gross margin is the accounting term. Contribution is yet another non-GAAP measure. But you can't manage a business with gross margin. I'll explain to you why sometime in a future episode, but you just can't do that. You need to focus on contribution margin, but you increase your contribution margin, you lower your fixed costs, which here is reported as SG&A, sales, general administrative expenses. In that order, contribution margin, lower your fixed costs, increase your revenue last, but the concept here is to do the revenue growth piece last. That is the first principles. Take one step back, get your house in order, start making money, make the formula work, and then scale. Do not scale on a flawed business model, which is really the go-to way to do things in this industry. But you can change that. You can change that, and that's what's going on here. This company, I'll tell you how fantastic it is. This company, Cresco, has never, ever reported positive EBITDA or earnings before. In 21-22, they lost over $100 million each year. Now they're reporting $200 million in positive EBITDA. What a turnaround. What a turnaround. The theme in all of my content, even outside this podcast and other content that I do, and in all the businesses that I own and everything that I'm doing in 2025, the theme for 2025 is defense wins championships. Get your house in order. Scale back. Get your foundation strong, and then go from there. It appears that's what this Cresco has done, and that is fantastic. Now, I'm running a little bit long maybe, but let me just cut to the next point of this. So they have this fantastic release last week, and what happened to the stock? Well, nothing. Absolutely nothing happened to the stock. On the OTC listing last month, in the last 30 days, they had a high of 96 cents and a low of 70.1 cents. All of that, I typed that wrong in my notes, I put $70, but it was 70 cents, 0.1, which was right at the time of the release. So they're at pretty much at all-time low. And I looked at the Canadian trading as well. I did not look at Frankfurt, but in Canada, they're about the same in CAD, not in US dollars, of course. Their average 3 months volume is about 725,000 shares on the OTC, which is roughly 10,000 to 12,000 shares per trading day. Okay, so that's their volume. And if you do the math on the turn that into dollar value, you'd look at $7,000 to $9,000 of trading per day. That's it. Nobody cares. Nobody cares about this stock. The volume on the CSE is a little bit higher, as it always should be, compared to the OTC in the US, but still is nothing. No one cares in the public markets when the industry is out of favor, such as cannabis, and you're at this size of stock. You've gone from a large market cap down to nothing. It's hard to get attention. If you don't have a good promoter, a good story, a rising tide lifts all boats type situation, it's a tough slog. It's difficult to get some attention. So what's the point? The point is, as I said, is nobody cares. The market cap on this company with all of this is $250 million. But why? Is it because there's a bunch of trading and is valued at $250 million, although that's the math? No, it's because there's 343 million shares outstanding. The stock could drop to 1 cent. It would still be valued at $3.5 million. It's just stuck. It's stuck at its trading range and gives you a false, I think, equity valuation, market capitalization. There's $683 million of debt on the books. So the enterprise value, which is the value of the equity, the market cap plus the debt, is about $933 million, just short of $1 billion, and implies roughly a 5 times EBITDA multiple on the 200 million. And except it's fake, as I said, because you can't get the liquidity to realize on any of that. So what's the lesson? Why am I telling you that? Well, I think you need to ask yourself in your cannabis business, why? Why are you public? Why do you want to be public? Is that first principles? Is that stepping back, making money, raising capital? I understand that sometimes it's easier for people to raise money in a public shell, in a publicly traded company. Some people are better at that. Some people are better at raising money privately. Sinclair Range, if you go to us, we'd be good at doing both. But you got to ask yourself, why am I public? I'm not getting any liquidity. My employees aren't getting rich. It's not like I could do a public offering and raise a bunch of cash for equity. Not that this Cresco needs cash. Maybe they do. I haven't done a liquidity analysis on them. But you can't raise a bunch of money with the stock at this price and with this liquidity. So why are you maintaining 3 listings in 3 countries? Okay, now I'm not picking on Cresco for that. I'm just saying in your business, you need to think about that. You should all consider going private. Every last one of you. May not be the right answer. I'm not saying you all have to go private, but you all need to think about it, and you can always go public later. That's it for the week. I want to tell you more stories about public cannabis companies, but that's it for this week. Thank you for listening. Go to wherever you've heard this and subscribe, like, participate, reach out to me. What topics would you like covered? Would you like to be interviewed and have a discussion? Because I want to bring guests in on this show. But for this week, that's it. Talk to you next week.